It began with a handshake in a quiet cafe, a founder with a whiteboard sketch, and a billionaire investor with quiet conviction. One asked the other, "What if we built something nobody else believes can be built?" That question has echoed from Silicon Valley to Singapore, from Lagos to London. Behind the world's most transformative companies sits a hidden operating system, the playbook of the billionaire venture capitalist. It's engineered. This playbook matters now more than ever. Capital is consolidating, winners are getting larger, and the distance between top-tier investors and the rest is widening. According to PitchBook's Q1 2025 Venture Monitor, global VC deal value hit $73 billion, but that capital is flowing into fewer hands and more concentrated bets. The new game is not about chasing every opportunity. It's about building the future before it becomes obvious. Venture capital is quietly reshaping the global economy. Once dominated by Silicon Valley, it's now a worldwide network. Forbes' 2025 Venture Capital Outlook reports the modern VC model has shifted from spray-and-pray investing toward highly selective, thesis-driven funding. These funds start with a worldview, a prediction of where the next decade is heading, and deploy capital accordingly. Alternative assets continue to attract the world's wealthiest families. Bain & Company's Global Private Equity Report 2025 notes sovereign wealth funds and pension institutions are increasing allocations to private markets, seeking long-term outperformance as public equities stagnate. In this climate, billionaire VCs have become architects of tomorrow's industries. They create the conditions for opportunity to exist. The first rule of the playbook is intellectual discipline. Billionaire VCs begin not with a company, but with a thesis, a carefully built worldview about technological, demographic, or behavioral shifts. According to Forbes, many leading funds now spend months researching sectors before writing a single check. Andreessen Horowitz's early conviction in crypto, Sequoia's bet on mobile ecosystems, and SoftBank's global internet thesis all followed this pattern. When the thesis is right, the deals that follow become self-reinforcing, forming a strategic ecosystem rather than a random portfolio. This is why billionaire investors often appear prophetic. They're working from a model of how value will move through society, positioning capital ahead of that movement. The second rule is structural control. Term sheets may look like legal paperwork, but to seasoned investors they are blueprints for power. Preferred shares, liquidation preferences, anti-dilution clauses, and board seats aren't afterthoughts. They're design elements that protect control and preserve optionality. A well-engineered deal can magnify returns or safeguard downside, even in turbulent markets. According to guidance from major family offices and private equity advisors, structure determines as much of the outcome as the startup's eventual success. Billionaire VCs understand this deeply. They design for influence long before success is guaranteed. In venture, the best deals rarely appear in public. They move through closed circles, introductions from founders, referrals from other investors, or insider communities. PitchBook data shows top-tier funds capture a disproportionate share of breakout deals through referral networks. This is the billionaire advantage, access that cannot be replicated quickly. That's why top investors invest relentlessly in relationships. They mentor founders, support accelerators, and build informal pipelines long before financial returns. These connections are the arteries of the venture world. The result is compounding access, a network that feeds on its own success, creating perpetual deal flow. Money alone doesn't scale startups anymore. The billionaire VC's edge is operational leverage, building an ecosystem that multiplies each dollar invested. According to Bain & Company, funds that provide post-investment operational support outperform those that act as passive financiers. This support includes helping startups recruit key executives, negotiate with enterprise clients, and connect with follow-on capital. Sequoia Capital's Scouts program, or Andreessen Horowitz's in-house teams are examples of VCs turning themselves into full-stack business accelerators. Billionaire investors know their role is not just to supply capital, but to construct networks that increase survival odds across their portfolios. It's a system of self-reinforcing success. The fifth and perhaps most underestimated rule is patience. True wealth in venture comes from holding through the long arc of innovation. According to Cambridge Associates Private Markets Index, Top quartile VC funds often take over a decade to realize peak returns. The biggest winners, from Google to Stripe to ByteDance, required years of unglamorous persistence. Billionaire VCs understand asymmetric payoff. One success can return the fund, sometimes 100-fold. They're comfortable with waiting because their system is built on probabilities. It's this patience that separates investors who build fortunes from those who simply chase hype. Time, to them, is a strategic weapon. There's another evolution underway. Business Insider reports that leading early-stage investors are writing fewer but deeper checks. Instead of investing in dozens of startups, they focus intensely on a small set, providing resources a founder couldn't buy anywhere else. This focus reflects a new awareness. Scale doesn't come from volume, but from insight. A single great company, nurtured with discipline, can generate returns that eclipse a dozen mediocre ones. For billionaire investors, this isn't risk aversion, it's design. They know that concentrated conviction, when combined with the right structure and thesis, beats diversification without understanding. Venture capital is also globalizing. Funds in Singapore, Dubai, and London are competing head-to-head with Silicon Valley's elite. According to the Financial Times, Asia's share of global venture funding now exceeds 40%, driven by AI, fintech, and consumer tech ecosystems. Singapore's Temasek, India's Tiger Global, and the Middle East's Mubadala are deploying billions into frontier markets. This global spread changes the billionaire playbook. Success now depends on cross-border networks, regulatory fluency, and cultural intelligence. The next unicorn might not be built in California, but in Jakarta, Nairobi, or Riyadh. This isn't just about wealth. Venture capital shapes which technologies humanity adopts, from clean energy to artificial intelligence. When billionaire investors decide where to place capital, they are indirectly deciding what the future looks like. That's why understanding their playbook matters. It reveals not only how fortunes are built, but how progress is financed. According to Bloomberg, nearly 60% of the world's new unicorns in 2024 originated from venture-backed ecosystems. The influence of private capital now rivals, and in some sectors exceeds, that of public markets. In other words, the billionaire VC isn't merely funding innovation, they are curating it. They are setting the direction of human ingenuity. At the center of every breakthrough is belief, and the courage to fund it before the world understands it. Because behind every startup that changes the way we live, there's capital that changed the way it was possible. Did you find this video useful? Don't forget to like, subscribe, and visit our website for more stories. Link in the description. Follow us on our social media handles for updates and insights. Till next time.